Okay, so let's kickstart today's lecture. And we'll just do a quick introduction of what we have, what we're covering today. Maybe we'll cover a bit of what we have covered so far. And then the plan is that we'll cover the lecture materials. After that, we'll go through two self-practice questions, mainly because the self-practice question will help you understand more of the what we discussed today. And last but not least, we'll go through the TMA answers as well. And of course, that is a part of time that hopefully you have some questions, and then try to address them at TMA, because I think it's important as well for even your project as well as your finals. And as usual, feel free to either type on the chat or unmute yourself if you have any questions. Right? Okay, so today, so what we've covered so far. Let's do a quick recap. So in the first lecture, we talk about more like qualitative assessments or doing a valuation, right? We're doing a valuation module. So we did qualitative. In the second lecture, we covered more on general quantitative methods, right, in doing the actual valuation. And we just did a very brief overview of the various methods, right? And then in lecture 3, we dive quite deep into the DDM, dividend discount model. And this lecture will focus purely on the free cash flow model, meaning we'll be focusing on the free cash flow to equity and free cash flow to firm, right? And we'll be using the same concepts that we have covered in the DDM, largely, the two-stage process, the single stage, and as usual, we not cover the three-stage because the three-stage is out of syllabus. All right. Quick side note: those of you that downloaded the slides way in advance, meaning like 2 weeks ago, I have actually updated today's lecture slides, lecture 4. Largely to actually be more precise in terms of the formulas for the FCFE and FCFF as well. So if you did download the slides from the previous, like 2 weeks ago, I encourage you to download the new one. I uploaded this slide last week. As well as I have also updated some the FCFE and FCFF formula in lecture 2 to ensure consistency. So basically, if you just follow lecture 4 slides for the formulas, that'd be fine. But if you like to retrospectively go back to lecture 2 to just adjust the formula, you can just do that. I have also updated those slides as well. Right? Of course, if you have any questions, let me know. Right? Okay, so let's start for free cash flow. So we'll jump straight into the free cash flow model since we have already covered the basics in lecture 2. So and then now, as usual, we are going to do the single stage and double stage, and we'll not do three stage. Okay, so for the FCFF, just a quick question. Anyone recalls what's the difference between FCFF and FCFE? Yeah, okay. One is firm, one's equity. In terms of the formulation, which one has the debt as part of the calculation that you have to so-called add back the net debt? Yeah, that's right. So the firm has the debt, correct. So the answer is actually covered here. The firm has the debt. But yeah, so we'll first cover FCFF. So the FCFF meaning is for the firm, meaning where you have to consider both the debt and equity component because we're considering the whole firm, right? Okay, so in the standard, let's say a no growth situation where you don't expect a growth in the cash flow, this is simply a perpetuity, right? I hope you remember what's a perpetuity formula. So it's simply a perpetuity. At the same time, because it's FCFF, we're considering both equity and debt component, we have to use the WACC here. All right. So one important thing to take note, as you mentioned earlier, that the FCFF component includes the debt, right? So there is this general form where we can say that the value of the equity equals to the value of the firm minus the market value of the debt. So what does this mean? It means that if we find the value of the firm using the FCFF, right, we can actually derive the value of equity if we are given the market value of the debt. All right, let me repeat this again. So if we use FCFF to get the value of the firm, right, and we are given the market value of the debt, we can actually find the value market or the value of the equity by taking the value of the firm minus the market value of the debt. Right? We have one example in the lecture later to see this how this plays out. One important thing also to take note is that you want the market value of that. So, sometimes question can be very tricky where they give you, let's say book value of that. Book value meaning the value on the balance sheet. So this is not market value. So you don't want to take that value. You always need to use the market value. This is important here. And once you're able to find the equity value, you can simply take the equity value divided by number of shares to get the value per share. Right? This is a calculation for market value of debt, number of bonds outstanding times the market price of each bond. I want to again highlight here again is the market price of the bond. So you're not looking at the par value, right? I hope at this point in time you are very familiar with bonds and what's the difference between the market value and par, right? So that's the difference. So par is where at the end, what is the so-called the price of the bond that you'll get back, or you have to pay back, right? So usually it's 1,000, right? The par is at 1,000. Okay, so this is a single stage, no growth. Remember, it's just a perpetuity. Now, very similar to your DDM, if it's a stable growth, so that means there is a stable growth here at G. So there's a record here. Then you use a growing perpetuity, right? So because it's just growing non-stop at a rate of G. As usual, I want to highlight to you that the value of G cannot be greater than WACC, right? This is an assumption that has to be made. Okay, now this is the part that I would like to really focus on because recall last 2 weeks ago I mentioned that the tricky part about FCFE and FCFF generally is how do you derive the cash flows, right? So in your DDM, because it's dividends, you just follow what has been declared, right? What's the dividends declared? What's the cash flows amount? So it's kind of simple, but for the cash flow model, the very tricky part is about calculating the cash flows. And I believe that you have already tried, you have done your TMA, so you have already tried doing the calculations, although those are kind of simple, and you will notice why later. Because when we cover this in more detail, you'll see that a lot of small things that you take note of, right? So this is the slide that has a bit of I did some amendments. So in case you're still using old slides, please download the new slides. All right. So let's see what these slides show. So basically this slide, right, gives you a quick summary of all the FCFF formula. So in case you need a quick reference, refer back to this slide. It's just a summary of all the formulas. Of course, we'll explain in detail of them step by step. All right, so let's start off with the most basic form where we do the net income, right? So if we start off with net income, we add back the depreciation, which are because they are non-cash items. We add back the interest, right? This is the part where there was a small clarification. So it's 1 minus tax, so interest times 1 minus tax. And then you have your capex, so in the minus capex and minus change in net working capital. So at this point in time, I want to highlight to you that this is change. So there are quite a few students actually in the TMA, you kind of just use net working capital in your calculation, but that's incorrect. You need to use the change in net working capital. So I believe in lecture 2, I kind of try to stress this point again. Um, and I would like to stress it once again. You need to use the change in net working capital. So what is the difference in the years, right? 2020, let's say 23 minus the net working capital 2022. So it's the change of net working capital. All right. Anyone have any questions regarding this? So I want to repeat again, is change in net working capital. All right. No. Okay. That's good. All right. So then we have various other derivation using EBIT, EBITDA, and last but not least, the cash flow from operations. And this cash flow from operations, sorry, and this cash flow from operations, yeah. So any this cash flow from operations is based on the cash flow value in the um, cash flow statement. And as you have probably already know that the cash flow in the cash flow statement inside the annual reports are different from what we're calculating here in finance. So there is a difference between the cash flow there, because that is based on accounting rules. But what cash flow we are using is based on finance rules. But in this FCFF formula, we can actually derive the FCFF using the cash flow from uh, operations from the cash flow statement. So it's CFO. You add back the interest, and then you minus the net worth, so what capex minus the net capital spent. So the next slide basically is a proof of showing you how we get the formula from let's go back. How we get the formulation from here. Seems like my pet's not working too well today. How we get the formulation from net income to EBIT. So I think I received a few questions of you asking, oh, how come there is there's interest here, and why is it minus tax? How come here depreciation you must multiply by tax, but this one you don't have to multiply by tax, right? There's like so many questions, like how come the formulas look so inconsistent? But which is why I actually added in this slide to show you the proof that they actually make sense if you slowly derive the proof. But I want to say again, this is purely for explanation, so you don't have to memorize the proof. You'll never be asked to show the proof. But I just wanted to show you the proof so that you can't understand that the formulas are not just random, like, oh, why the EBITDA one, you must multiply by depreciation plus depreciation times tax, but the others, you just plus depreciation. Right, so let's tackle the formula for the difference or how you actually get the EBIT formula. Right, so we start off with net income. Right, so we know that net income here, net income equals to EBIT. What's EBIT? So EBIT is earnings before interest and tax. Right, so if we minus interest and we minus tax, it will give us the net income. Right, everyone got that? Everyone got this? Yeah. So and once we know that, I just did a multiplication. So like I just multiply EBIT times 1 minus tax, which I get this here, minus interest times 1 minus tax, so I get this, right? And then what I do, I shift the 1 minus tax. So I shift this to the left here. That's where you get this, and you get EBIT minus 1 minus tax. All right. So now I'll just add back depreciation on both sides, because you know this is an equation, you can just add depreciation. because it cancels out, right? You add the left, you add the right. So I add depreciation, do it like this. And we call that the first formulation of net income plus depreciation plus interest times 1 minus tax, this part here, equals to this part, right? And so if this thing equals to this, you can just plug this EBIT times 1 minus tax plus depreciation into this formula here. And that's where you get your EBIT formula. Any questions for this? Is it quite clear on this proof? All right, all good. Okay, that's good. So it's clear. So, initially I was thinking to actually write the proof, like as I explained. And I was thinking, oh no, it's better to just type it out. So that's why I added this slide, because if it's typed out, at least you can just refer to it straight away. You don't have to copy down the proofs in case you want to refer to it in the future. So yeah, just added these slides. Why does environment? Oh, yes, because I'm in office today. So normally I'm at home. I try to work from home on days I teach, but today no choice. I have to come to the office because of physical meeting. And in the morning here, so that's why yeah, the day just started in the office. Yeah, no problem. Okay, let's go on to the proof for EBITDA. All right, so let's start with the basic formula first. What's EBITDA? So EBITDA is earnings before interest, tax, depreciation, and amortization. So in this case, we just omit amortization. We just treat amortization and depreciation the same. So how do we get EBIT? So EBIT is basically the EBITDA. You minus away the depreciation and amortization in this case to get the EBIT, right? And as usual, I multiply both sides by 1 minus tax, and that means, kind of cancel out, so it's fine. I can do that. So I multiply by 1 minus tax, I multiply by 1 minus tax, right? And then what do? I add back depreciation on both sides. So let's add back, right? Remember, if you do things on both sides, it's fine. Can do anything. Can add 1,000 on both sides, it's fine. That's the equation. All right. Now, then I start doing a bit of manipulation. So I again now multiply EBIT by 1 minus tax, which is given here, minus depreciation times 1 minus tax, which is I actually multiply it out. So minus depreciation times 1 equals minus depreciation times negative tax will give you depreciation times tax. And I just put back the plus depreciation here. And immediately you realize something. Can you see that minus depreciation and plus depreciation cancel out? So what is left? So what's left here is just the EBIT times 1 minus tax plus depreciation times tax. All right. So now you can see why in the EBITDA formula, you actually add depreciation times tax. Okay. And as usual, since this equals to this, I can just plug it back into the EBIT formula, right? And you get this. So again, I want to repeat that you need to be very careful when you use the various CFF, FCFF formula. If you're using the EBITDA one, you need to make sure your depreciation is multiplied by tax. If you didn't use that, you use an EBIT, make sure you add back your interest, minus interest times 1 minus tax. All right. So flipping back to this slide, I want just to put a big star here. This is kind of your summary slide in case you're doing your GPA, you're doing your final exam, for the so-called the take-home assignment final exam. Refer to this, as this gives you a good summary of all the formulas you can use. And you do notice that for your FCFF, because you're calculating for the firm, you don't need to consider the debt component, right, in your free cash flow, because it's to the firm, and firm meaning the debt to end equity holders, right? So there's no plus net debt, which you normally see in your FCF. Okay, so we have an example here. Let's look at this example. So we have this company that has a revenue of, it's quite a lot of information, of 120 million. EBIT margin is 20%. Okay, working capital as a percentage of sales is 30%. Remember, for working capital, what we are interested in. For working capital, we are only interested in the change, right? But this is working capital, so we need to consider change. Um, it's it has a debt market value of 800 million. Okay, fine. We are given the market value already. The company has a target capital structure of 40% debt. Okay. Cost of debt is 8%, cost of equity is 14%, number of shares outstanding is 50 million. All right. Calculate the value of the share using the uh, FCFF model. Tax rate is 20% here. And this last assumption is super important. I would like to put a big star here, that the capital investment will be offset by depreciation. So this is very important. It might not always be like this. So later there will be one more example where you see that the offsetting doesn't happen, but this is an important assumption, right? Because it will impact your NCS component of your FCFF. Okay, let's see how it's being done here. Okay, so let's do a few calculations first. We are given that revenue is 120 million, right? And we know that the EBIT is 20%. So we can calculate EBIT here. The last assumption that I put a big red kind of star, capital investment equals depreciation. Fine, we can do that. Okay. So working capital, what was mentioned? Working capital is 30% of sales. Okay. So we do have your revenue, which is sales. So 30% of that. Okay, that's good. We know that revenue will grow at 10% per year. So we know next year's revenue, which is 2020 revenue in 2012. You just multiply by this. Your EBIT is the same, as in 20% of the revenue, and your capital, working capital now is 30% of the increased revenue, right? So we get this. This will allow us to calculate the change in working capital, right? And this is what we want to calculate. I repeat again, we need the change, not the working capital. Okay? Because when you do your GBA, when you do your finals, please make sure you do a change, because if you just take working capital, your answers obviously will be wrong. Okay? And the problem with the cascading down of this effect, right? I can usually try to give error carry forward, but sometimes it might make you comment wrongly. So that's the part where if you comment wrongly, you cannot get error carry forward. But for like calculations wise, you can get error carry forward marks. So that's why I want to highlight the importance of making sure you use the right formulation. So this is the change. So we get this. Okay. So now, having calculated your working capital, we have also calculated your EBIT. Recall your FCFF formula using EBIT, right? So we can simply just see. What we have your EBIT. Okay, perfect. We have EBIT here. We multiply by the tax, because tax was set at 20%, right? 20%. And then you minus the net working capital. change in net working capital, right? So you're using this formula here, EBIT. And why we did not consider the net capital spend here, this net capital spend and depreciation. Why? Because the question say that the net capital spend equals to depreciation. In a sense, not equal as in it nets off, right? That's why we did not consider the depreciation and the net capital spend. So this we don't consider this. So this basically nets off. Everyone understand this portion about the netting off of net capital spend and depreciation? Yeah. So I want to highlight again that please read the question carefully, right? Do not assume that the netting off happens. And of course, if you assume wrongly, yeah, this is wrong. So you need to be very careful when you make such an assumption. So in this case, the question mentioned that netting happens, so we can do that. Okay, so now once we have the toughest part, right, is the calculating the cash flows, right? In this case, the free cash flow to firm. Now, once we have done that, because we know we are valuing the firm, what we want is we want to calculate WACC, which we do here. And remember, for the debt component, there is a 1 minus tax, right? Because that is, we can less off the tax component here. And we know the target debt structure. Let's just flip back and have a look at what is the target debt structure. Structure of 40% debt. So we know the target is 40% debt. So we multiply by 0.4 and then the rest are equity. Okay. So once we get the WACC, we know that the question say it is a stable growth firm, meaning we are looking at a growing perpetuity. So we simply take WACC minus the growth rate, and we take the growing perpetuity formula. All right. Notice, I want you to notice something. Why did we not multiply by 1 plus G? Anyone knows this? Why? How come we can just take this FCFF divided by the WACC minus G? How come we didn't multiply by 1 plus G again? Anyone knows? How come we didn't multiply by 1 plus G for the top? Because this is kind of, so I think in the TMA, some people might multiply 1 plus G, some didn't. Like, there's a lot of formulation. So how do we know? Should we multiply 1 plus G? Should we not multiply by 1 plus G? So let's look at the question. Anyone know or don't know? You don't know also, I can explain. Yeah, okay, it's constant, but how come we didn't multiply the top value? So I'm just going to flip back to the formula. Here, can you see here? See, there's 1 plus G here. How come we didn't multiply by 1 plus G for, for this question? Okay, so maybe it's not so clear. All right, so let's have a look here at this question. So this is a small little, well, I will not say trick, but you need to be very careful when you see this. So we know that this company revenue starts in 2021, right? So let's draw the timeline here. There's no space. Let me just hop over to my oops, so it's easier to draw. Okay, so you have the question in front of you. So we have year, let's say 2021, right? Because the question now is 2020, 2011, just see, 2011, sorry. So we have 2011, right? 2022, right? So these two are the years. And then maybe you have 2023 in the future, right? Uh, why am I keep on thinking 2023? So 2012, 2013, right? Okay, so we know that we are at 2011 now, right? We are here now. The thing is, we calculated the FCFF at 2012, right? We did that because how do we know we did calculated the FCFF 2012? Is because can you see we are working out the working capital requirements for 2012, and then the FCFF is 2012, right? We are not able to calculate the FCFF of 2011 because we're not given the working capital requirement for the prior year before 2011. Everyone got that? So we are actually calculating the FCFF of 2012. Okay, perfect. So what does this mean? Remember your time value of money. So that's why I like to always refer back to the formula. You are using, whether using a perpetuity, whether you're using a growing perpetuity. The idea being that, you know, remember your growing perpetuity, what happens? You are going back to year zero, right? And the formulation works that your cash flow here. So this is, let's say, your FCFF here divided by R minus G, right? In this case, it's WACC, the R, right? And it goes back because it is always one period from today. Remember lecture 2, I repeated many times, one period from today. So in this sense, the FCFF is already one period from today. So you do not have to multiply by 1 plus G. And so you just take whatever value calculated for your FCFF, uh, this amount, and then you just divided it by this here. All right, so it really falls back to your basic of time value of money and recalling what formula you use. In this sense, you're using a growing perpetuity. And because this FCFF is already one period from today, and today is here, right? Today is here. Your FCFS is already one period from today, so you don't have to multiply by 1 plus G. Everyone understand this part? Yeah, very good. So the thing is, if if the question somehow gave us a calculation of the FCFF in 2011, which is now, then what do we have to do? Then we will have to multiply by 1 plus G before using this cash flow to have a growing, use it under the growing perpetuity and discount it. If it's given here. All right. Okay, so I hope this is clear why there's no times 1 plus G. Once you calculate the value of firm, recall the formula that if you want to find the value of equity, we just take the value of firm minus the market value of debt, which is given here. And we can calculate the value of the share divided by 50 million shares. Right, and this is the value. So this is a very classic example of your FCFF. It teaches you how to calculate the values. So it will be important, of course, for your finals. But I think now as we work towards more of your GPA, your project, we'll actually need to understand how do we get all these figures, all these working capital, all these figures, like where do we plug them from the financial statement? And so this is why I'd like to go through at the end of this lecture the self-practice question, right? How you plug numbers from the uh, financial statement. Because remember, of course, when you do your project, there's no question per se, right? It's just you're supposed to plug the numbers from the financial statement. Okay, any questions for this before we move on? None? Okay, very good. Okay, so just a bit of theory for why do we not take into account depreciation. So this is just more of explanation written in a nice form. But remember, I explained to you because the questions say that the net capital spend is going to be offset by depreciation, right? So this is a kind of explanation why. So there are, of course, there are two stages: high growth and low growth stage. So in a high growth stage, the assumption is that the amount of working capital investment equals to the difference in the gross fixed asset of the two consecutive period, right? And so the need for this capital investment, right, the amount of capital investment required is therefore provided by the depreciation charge. So basically there is whatever depreciation in charge is equals to amount of capital that you need to spend so that your so-called capex remains constant. Does that make sense? So you whatever you depreciate, you need to replace it by new capex. So there is a perfect alignment, and therefore, you don't need to consider that. So in this case, you only need to provide for capital investment beyond the depreciation charge, right? So another explanation, in case this is a normal growth stage, it's the same thing, right? The assumption is that the fund needed for capital expenditure will be provided by the depreciation. So in this sense, again, it's the same. So whatever additional money that you have to invest in new fixed asset is equals to the depreciation that you charge on the fixed asset, right? So there is a perfect netting off as well. Again, it's the same thing. You only need to provide capital investment beyond the depreciation charge. So I put this blue double star here again because this is the part that most of the time has become a trick in the question where sometimes they say that it's net off, sometimes they say it's net off in year 3, sometimes they say it's net off in year 5. So you really need to be very careful when the netting happens. Okay? Or if the netting happens at all. So yeah, do not assume. Okay, so we have covered a single stage. Let's cover the two stage, FCFF. If you recall, so now this is just a slight recap. Recall when we did the DTM for two stage, I mentioned that do not memorize this formula here. Do not memorize this formula. It's not a star. It is X. Why? Because to understand the concept is more important, right? So what is the intuition behind the two stage? Anyone can recall what's the what they are explaining? How do you think about doing the two stage? All right, okay, I see. All right, PV of cash flow, okay, and growing annuity. Yeah, okay, so PV of cash flow or growing annuity, okay, then what must you add? Plus PV of terminal value. Perfect. Yeah, that's a good teamwork. Well, yeah, terminal value. And remember PV of terminal value. That's the important part. It's a PV. Yeah. So yes, you're right. So think of it as the first component, first stage as a stream of cash flows. All right. And you can do either PV of cash flows or growing annuity, depending on what you like. And then the second stage here as terminal value, but you must remember to PVE back, which is what is being done here. You PVE back using the WACC. So if you segregate this, you should be very clear about which is the growth value you should use. All right, growth value here, which one, right? Okay, so we do have a question here. As you notice, it gets a bit longer and longer, more information. But let's try to dissect this slowly. Okay, so we have this company again. Current sales is 50 million, expected to grow at 14% for next 4 years. Okay, we are given a 4-year period. From year 5 onwards, the growth is expected to be a normal growth at 6%. Okay, so initially it's 14, and then it goes to 6. And I have drawn this small little graph, which I mentioned I like to do because it helps you visualize. Usually it's not given the question, right? So we have already put down the high growth is 14, low growth is 6, and the low growth or the normal growth actually happened at year 5 onwards. What else? During the growth stage, only growth stage, capital investment is expected to grow at 20%. Okay, while depreciation is expected to grow at 25%. Okay, so there is no netting that's happening in the growth stage. All right, no netting. Okay, what else? During the normal stage, depreciation offsets the capital investment needs. Okay, so netting happens in the normal stage. EBIT margin remains at 24%, that's fine. Working capital remains at 20%. Okay, 20% of sales. Recall that we always want change in working capital, right? So we need to calculate change, not just working capital. Currently, equity is 20 million, debt is 20 million, number of shares outstanding is 1 million. Okay, cost of debt is 10%, and this is after tax. Cost of debt during the normal growth stage will fall to 9%. Okay, so that means cost of debt at high growth is 10, low growth or normal growth is at 9. Capital investment last year was 20 million. Depreciation was 1.6 million. So now they provided data last year, right? Why they do so? So you can calculate what is from year 1 onwards, year 2, year 3, year 4, right? Because we know that it's a growth. Risk-free rate is 5%, blah, blah, blah. What else? Market risk premium is 7%. During the growth stage, we know there are different beta. First beta is 1.4, and next beta is 11, right? 1.1 for your normal growth. Okay, calculate the value per share using the FCFF. I want to highlight to you here, you notice that they say calculate the value per share. So what does it mean? They actually want you to calculate the value of the share, which is the FCFE, but using the FCFF model, right? Everyone notice this? They want you to calculate FCFE using FCFF. All right, so we need to, of course, you know the formulation where you have the FCFF, you minus away the market value of debt, you get the FCFE, and then you do, because it's per share divided by number of shares. Okay, so we have dissected a question. Now let's do the simplest component of this question first. Let's calculate the cost of equity and the WACC, right? So we know that at the high growth stage is 1.4 in beta because it's more risky, right? More systematic risk. So we have 1.4. Normal growth is 1.1. Less risky now, less systematic risk. And we do the WACC now, right? We are given 2 different capital structures. Let's just quickly refer back to the question. We are given that, let's see, can you see here? Current equity is 20, debt is 20, right? So we know that at the moment, the capital structure is 50/50. Okay. And we also have a last little small component here that they tell you tax rate, and they also say the normal stage equity accounts for 2/3, debt accounts for 1/3, which is where we got the change in capital structure here. Okay, so we calculated all these figures. Just a small note I would like to highlight here is that whenever you calculate your WACC or your cost of equity in let's say your GPA or even your finals, please make sure not to round the figures up or down. Take the full value given in Excel, right? Why? Because your discount rate, right? The WACC and your cost of equity are all discount rates. Your discount rates actually impact your terminal value a lot. As we mentioned previously, right? The growth or the discount rate actually impacts your terminal value. So sometimes, right, if you just round it by 0.1%, your value can be very different. So your answers will not be too accurate. Usually we don't really minus too much marks or at most just 1 or 2 marks, but just want to be sure that you don't lose such unnecessary marks. So do not round the values, right, for your discount rates. Okay, so now this is the tough part, right? Like I mentioned, the tough part of free cash flow is uh to find out the cash flows, right, using the formulas. So in your GBA, in your finals, I highly recommend you do a table like this. You do not have to show all the workings here, but you need to make sure that in case the marker needs to see where you went wrong, they know how to derive your working, right? So for the finals, I'm not sure whether I'll be marking your paper. So it really depends on the marker, right? So you need to really be able to show the marker, okay, if your working is wrong, how do you derive so that he can give you better marks? If you just simply, let's say, right, if you just simply just put 0.9, 10.94, 12.48, of course, the marker do not know how you get this number. And let's say you are off by, let's say 0.1 or 0.2. He can't tell. You might not get the mark, right? So just want you all not to lose any unnecessary mark. Please show your work. Okay, so there's a sidetrack, but let's go back to the question. So we know that sales is growing at 14%, as they mentioned. So recall, let's just flip back to the question. Recall that they mentioned the current sales mean year zero is 50, right? And they say grow at 14% for the next 4 years, and after that 6%. So what have we done here? We know current is year zero, 50, 14%, 14%, 14%, 14%, and 6%, right, in year 5. Okay, so going to the EBIT, EBIT does not change. It's always 24% every year. We multiply by 24, 24, 24, 24, 24. So of course, I'm showing a lot more working for redundancy. I did not calculate the values out. I want to show you all the workings, just for explanation purpose. But you don't have to do this. We know that we are using this formula, the EBIT formula. So we must multiply by 1 minus tax. And no tax rate is 20%. So we multiply by 1 minus 0.2, 1 minus 0.2. We just multiply it like that. All right, and now I work out the values here given. Okay, so the question gives us what? The depreciation at 1.6, right? Let's just flip back quickly, have a look. Depreciation was 1.6 here. Okay, so we know that year zero is 1.6. Depreciation, we know that depreciation grow at 25% or the high growth stage, right? So we increase by 25% here, but only high growth. When at normal growth, offsetting happens. So this is offsetting. We know that the net capital spend is given at 2 million. Let's just flip back quickly to just confirm. Right? Capital investment was at 2 million. So we know that it grow at 20% for capital net capital spent. So 20%, 20%, 20%, 20%. And we know that a normal growth offsetting happened. So here is offset. What else? Let's see. Let's flip back to the thing. We know that the capital, sorry, the growth working capital remains at 20% of sales, right? We have already highlighted here. And we want the change. So let's calculate what's working capital first. So we know the sales is given by here. So 20%, we just multiply 20%, 20%, 20%, 20%, 20%, right? 20% of sales. But what's important is that we want the change. Again, I'm going to put 2 stars here. So we find the change given at these values. Now, we have all our values ready. So this slide is kind of, this portion here is kind of unnecessary. I just want to repeat again for presentation to show you that I'm using this FCFF formula where I calculated all the values in bold. So in the last slide, right, you know, those value in bold, like all this, I have transposed it to the next slide here. So you see all the bold values are here. All right. And I simply just put in all my values for FCFF formula, right? We have EBIT times 1 minus tax. We add back your depreciation minus the net capital spent, and we minus the change in net working capital. We want to highlight here, offset happened here, so we don't consider that anymore. We have calculated WACC. Remember, at high growth for the first 4 years is this, and at a normal growth, it drops. It's less risky, so WACC drops. Then what do? We PV the FCFF, which we have done here, using the WACC. But recall, normal growth, high growth ends in year 4, right? So when you calculate year 5 is where you use your PV of PV, right? Present value of your terminal value. So for terminal value, we use the growing perpetuity, as mentioned by some of you earlier. So this is your growing perpetuity. Again, we did not multiply by 1 minus G because of the timeline. So it's the same explanation as, I'm just going to jump back to this, as this it's the same explanation as this here. Here, this one, right? So that's why we did not multiply by 1 plus G, right? So we calculate terminal value using the growing perpetuity. We do the PV of TV given by here, all right? And last but not least, we add it all back. So for explanation, I've added the timeline here to explain the reason why we did not put the 1 plus G for the terminal value. So we are given the cash flows. I've added the cash flows here, right? The 4-year cash flow, we discounted number 1 back to year 0. Next thing, we calculated what is the TV, right? And remember, TV, I'm going to explain this again, that the TV we are calculating using the growing perpetuity formula, which explains that we take the value of 1 year from today, all right? Which is why when we calculate this at year 5, the TV is at year 4, right? So it means that we only need to discount it by how many years? 1, 2, 3, 4. We need to discount it by 4 years. That's how we get this. I'd like to just pause here. Do we have any questions? It's clear. Yeah. Okay, that's good. Okay, that's good. Questions? Okay. So uh, at this point in time, I just want to encourage you. If you do have some issues, feel free to ask questions. At the same time, if you are unsure about the cash flows, I really encourage you to just draw a timeline like this. It takes less than 1 minute, it doesn't hurt to just make sure that you are discounting things correctly, right? Once you draw a timeline, it's very easy to see. Okay. So value of firm, you just add all the values up. Value of equity, you minus the market value of debt, and value per share, you just divide by 1 million. So if you notice, like I mentioned earlier, the toughest part is usually the FC, FF calculation, how you get the cash flow values. But once you are done with that, it's all good. And it's kind of simple. Okay, so you know what? Now is a good time to let's take a quick, let's say 10 minutes break, or I mean 8 to 10 minutes, depending. Let's just do 8 minutes break. So let's come back 8:08. As usual, we'll do two breaks. So one now and one hour later, and we'll take a break. If you have any questions, feel free to put in the chat. And then we'll cover the FCF and we'll come back when we come back from break. All right. Right, welcome back. Hope you had some tea or coffee. I'm having tea now. Okay, so I don't think we have any question um for the FCFF. So let's continue with FCFE. All right, so again, we look at the two different stages. First, we do a first single stage FCFE by assuming no growth. Okay, so no growth. We are using a perpetuity formula, right? PV of perpetuity given by this. Uh, Given that we are using FCFE, we can calculate the value of the equity straight away already by just take the value of equity divided by number of shares outstanding, right? Straight away we get the value, so we don't have to minus the market value of that. In the second example of a single stage, we have a stable growth. Uh, Again, we are using the growing perpetuity. So now it's like a broken record, it's always the same thing. So we're using growing perpetuity. And yeah, let's now understand the FCFE formula. So this is a additional slide that I've added in case you're still using the old slide, the one posted maybe at least 2 weeks back. And so again, this is like a summary slide, which can refer to whenever you're doing your project or your exam. Okay, so first of all, I want to show you the formulation between the FCFE and FCFF, and it is given here, right? So how do you convert between FCFE and FCFF? Basically, FCFE is just FCFF minus the interest times 1 minus tax plus net borrowings. And I want to highlight these net borrowings. As mentioned, in lecture 2, what is net borrowings? Net borrowings basically is just the change in short-term debt minus the change in long-term debt. And again, this is change. So we want to look at change, not short-term debt minus long-term debt. Right? Remember, we are always looking at change. And the reason why, right, maybe at this point, I'd like to explain why, is because in finance, we are always looking at cash flows, right? And when there is a change in the amount of debt, there is a cash flow, right? Whether it's an increase of cash flow or decrease of cash flow, wherever there's a change. So is the reason why when we do FCFE, when we do FCFF, we always look at change. And so I want to highlight to you again that when you look at the net borrowings, we're looking at the change in short-term debt plus the change in long-term debt. Okay, so with this basic formula here, this is actually all that you need to know for the FCFE formula. And whatever formula that you see here is basically a substitution of your FCFF. All right, so what does this mean? So I show you the derivation using the net income. All right, so I basically just plug in. So this is the FCFF formula. Okay, wait, sorry, for that does it include all forms? Okay, that's a good question. So later in our self-review question, we are going to choose 2 questions. You will see what it includes. But basically what that does not include. So debt should not include payables. Payables are not included. Generally, deferred tax are not included as debt. So what are debt? So debt includes only notes payables, short-term debt, long-term debt, right? That's about it. Debt from related parties. Yes, you include. So if it specifically say debt from related parties, you include it. Yeah, but not payables from related parties, right? So everyone knows the difference between payables and debt. So payables relates to the uh, uh, suppliers, right? So if you have a supplier, yeah, creditor, supplier, you have a payable, right? So it relates to your everyday running of the business. For debt, it relates to the capital structure, meaning that usually debt is being used to finance things like capex, right? Yeah. And payables are more for trade. Yes, so it relates to like suppliers, creditors, those are trade related. So relating to your day-to-day expenses, working capital of your business. Yes, more long term, but remember debt can be short term. So you need to consider a short term debt as well, right? So how you think about it, debt relates more to capex, like investments. A payables relates to like working capital stuff. Credit terms. So this you need to look at the notes to financial statement. So credit terms, I've not seen this kind of instrument before because the credit term is like what is the conditions of the loan, right? Credit terms. Unless you're saying term loans, are you talking about term loans, like credit term loans? So if it's a term loan, then loans are debts, right? Credit term. Okay, if it's just credit terms, yeah, I guess maybe it might be payable, but how do you determine? You want to go to the notes to financial statement and read what does this line item means, because they do usually say, because I've not seen these credit terms before. If it's credit notes, that if it's credit notes, so notes are considered debt. All right, is that clear? So if it's a note, it's a debt. Yeah. If it's uh credit terms, you want to check because I've not seen this before. Credit terms. Of course, if you have any clarification, feel free to just drop me an email. We'll screenshot that thing and then I can see what's a credit term. Okay, okay. So going back to this thing, this component is basically the FCFF. So once you plug in the FCFF formula, you can do some simplification, which is what I've shown here. You cancel, and therefore you get this formulation of your FCFE. The same thing, this is your FCFF formula, and then you just you can do this one, you can't simplify, so it's fine. Your EBIT, you also this is your FCFF formula, and then that's fine, right? Okay, so what we have covered is this portion here, right? Using formulation from FCFF. Now, this is a unique formula using debt ratio. Okay, I put a star here. Why? It's because this is actually the formula that you need to use for your TMA. So later we'll go through a TMA, but the thing is, if they did not tell you what's net debt, but they tell you what's the debt ratio or debt target ratio or any kind of like debt ratio related, you straight away need to use this formula. You cannot somehow derive a net debt from a debt ratio, right? It's possible there can be questions that they ask you to derive the net borrowings from a debt ratio, but given that you already know that there is a FCFE formula using the debt ratio, why not just use it directly here? Okay, so in case some of you are reviewing your TMA, if you do see comments like, oh, this is the wrong formula, unfortunately, the problem is that the marking scheme is quite strict in the sense that if you use the wrong formula, there's very little like error carried forward because it's not really, it's like an error in like the wrong formula. Like it's not like a calculation mistake where you can get to the full marks using error carried forward. So yeah, so that's why you take note that you need to choose the right formula. Don't if you choose the wrong formula, unfortunately, the whole question you probably get maybe just 10% or 20% of the mark. Okay. So if that ratio is given, please use that ratio. Okay. Okay. So again, for FCFE, we have the two-stage. At this point in time, I will not spend time talking about how we derive two-stage. We should be quite familiar since we already talked about the two-stage in FCFF. Now, let's look at a question instead to derive the two-stage FCFE. So we have this same company. Current sales is 50 million. It's expected to grow at 14% for the next 4 years. From 5 years onwards, growth rate is expected to be normal at 6%. Okay, so we have, again, I draw this is exactly the same as the FCF formula, all right? And 5 years onwards is normal. During the growth stage, capital investment is expected to 20%, depreciation is expected to grow at 25% during this period. During the normal growth stage, the depreciation will offset so only normal growth, you have offsetting that's happened. Now they give you, see, net profit margin remains at 12% for the whole period. So once they give you net profit margin, I hope you should already think of the formula using the NI, right? Net income formulation, because they give you net profit margin. So you need to use the net income formulation. So that's how you know what to choose, right? So again, I repeat, if they give you debt ratio, use the debt ratio formulation. Don't try to convert the debt ratio into net borrowings and all those, because you can, but most of the time the questions is structured such that they do not give you enough information to do the conversion. So in this case, they give you net profit margin, so you just use the NI formula. Working capital remains at 20% of sales. Debt ratio remains at 40%. Okay. Number of shares outstanding 1 million. What else? The capital investment during the last 2 years is 20 million. Depreciation is 1.7. Risk-free rate is given in this. Market risk premium is 7%. They say that growth stage, there are 2 different beta, which makes sense. High growth, high risk, higher beta, higher systematic risk. Calculate the value of the company, so value of this company's share. Okay, so in this case, because we are doing FCFE only, we only need to use calculate the cost of equity, right? We do not need to do WACC. So we just calculate these two, one at high growth, one at normal growth. Now, again, this is the tougher part of any problems. And because just now that the ribbon was covering, and we want to use this FCFE formula. Hope you can see it. This one, using the net income, right? And because they also give you the debt ratio, so I'm using debt ratio as well. So actually, I'm not sure did any of y'all review like these slides prior to do your TMA, because actually this question like quite similar to TMA. If you oh, it did? Oh, okay. That's why I think those that did probably scored very well. Yeah. So for your GBA, I encourage you to review some more slides, because usually the setter of the TMA GBA is different from the person doing the teaching, right? So sometimes they do actually put information from like the other lectures that have not been covered yet. So yeah, it's a good strategy. Okay, so let's go back to the question. So sales, we know that sales grow at 14%. Okay, same thing, we just plug in the values, but at year 5, it grows at 6%, right? So 6%. We are given net income is 12% of sales, so we just put 12% of the sales figure. We know that depreciation is it was, let me just quickly have a look. What was it? Depreciation was 1.7 million. And what's the growth of depreciation? At 25%. So we are growing 1.7 million. Okay. And then we keep on growing at 25%. All right. And this is a normal growth. At the high growth, offsetting what happened. At high growth, there will be a growth of the depreciation, but at normal growth, offsetting what happened. And just now we saw that the net capital spend is 2 million last year, and it grew at 20%, as what we have done here. And the thing is, so I'm going back to the formulation here. So for the net capital spend minus depreciation, we want to multiply it by 1 minus that ratio. So this is what I'm doing here. I'm just trying to derive components of the formula. The net working capital is 20% of sales. Let me just quickly show this to you. 20% of sales. Here, remain 20% of sales. Okay. So we have 20% of sales, and we just have 20% of sales all the way, right? Just 20% of sales. But what we're interested in again is the change. So we find out what's the change. But this is not only that, but we want to find what is the change multiplied by 1 minus debt ratio. So I've done it here in red. I've done this. So now we have all the components in red, right? We have the net income, we have the this component here, and we have this component. So we can put everything together in the next slide. Again, I repeat to just for explanation. So we have all the components here given like this, and we just plug it into your FCFE. We know cost of equity at a normal growth is, of course, lower cost because lower risk. We do the PV of the cash flows. We do the terminal value, and we do PV of terminal value, right? And this terminal value is a perpetual, growing perpetual. So, I want to encourage you, if you have the time, try to do this example on your own in Excel without referring to these notes. Try to do it at least once to really understand what are the components you need to calculate. Because sometimes we'll look at the answers, oh, okay, it makes sense, it looks quite simple, you just put in all the values, but when you actually do it, it can be a bit tricky because the information is everywhere. So you really need to pick the information and really do it properly. So I really encourage you to try and do it on your own, right? Of course, there are some self-practice that you can try as well at the end of this lecture. Again, I done this for explanation, but I'll not repeat in the sense that we do the various cash flows. I'll not repeat this. And last but not least, we add back all the PVs and we divide it by 1 million shares. Right, any questions for this FCFE? Okay, perfect then. This I'll not go through the 3-stage, so don't worry, it's not part of the syllabus. I'll just put it here for you to have a look. If you do recall, we did an example for dividend discount using the 3-stage. It's kind of similar, the concept of it. So if you want to do it, yeah, you can do that. Because I know some of you all are doing or planning to do the CFA. So in the so this contains CFA level 2. So if you're doing the level 2, you need to know this, plus the 3-stage, because level 2 they do test 3-stage. So I just put this for your information for those doing the CFA. All right. So at this point in time, let's go through the self-review. I told you I want to go through 2 questions. Reason being because okay, so there are a lot of questions here. I encourage you to practice them, and there are answers provided as well here. But I want to go through 2 particular questions because they will help you understand how you pick the information from your P&L, balance sheet, cash flow statement, which will be very useful whether it's for your project in general or even your finance. All right, so the first question is question 4 here. Okay, so the focus of this question, I repeat again, is not about using the formulas. Using the formulas is fine, right? It's about the focus of this question is how do you pick the information from your financial statement. So now it's about picking. So previously we have been talking about how you use the formula to calculate your FCFE, FCFF, but now it's about picking the information. All right. So we are given here that net income is this, and we're just asked to calculate FCFE, FCFF, and show the adjustments that convert between them. Okay, so we're given the balance sheet. Okay, fine. We are given the income statement, statement of income, fine. And we're given the cash flows. Okay, so first of all, let's calculate FCFF. So the good thing is that I have already, or the answers already provided you the formulas that's supposed to use for FCFF. But let's see where do we pick the information. Okay, so net income. The first one we want to find net income. So net income, I think this is the easiest, is here, right? Net income. I think everyone can get that. Number two, we want to find what's NCC. Okay, NCC is basically just depreciation. They just put yeah, NCC, it's depreciation. So where can you find depreciation? So those that maybe major in accounting before or accountants, we know that the cash flow statement is very good source of information for cash for finance and as particularly for your cash flow calculation. So where can we get the depreciation amount? Here, 180. All right. Now, in case you don't want to use the cash flow statement, we can use the balance sheet as well. But for balance sheet now, we need to do some calculations. Let's see where. Here, can you see accumulated depreciation? Can you see the accumulated depreciation increased by how much? 784 minus 604. So if you notice, using the cash flow statement, we don't even need to do a calculation. But we can just pick the number straight away. And this is always true for whenever you want to find depreciation and some of the other items I'll explain later. Or if not, we can refer to the balance sheet. It's fine. Interest. Okay, where do we find interest? Um, so interest, can we do it on the cash flow statement again? We can. So I like to use a cash flow statement whenever I do free cash flow calculation. So here, this is your interest amount, interest paid. We can use this as well, interest expense here from the P&L. Let's look at the balance sheet. Do they have accruals for interest? Okay, they do have accruals for tax and expense, but they do not show a particular line item called accruals for expense, accruals for interest. So we can't determine the interest amount. Everyone okay so far with the picking the items, interest and depreciation? Yep. Okay. All right. Next thing. FC invest. So basically it's just this is the NCS, right? NCS. So NCS, again, we can use the cash flow statement, which I love to use. NCS is basically what's your net capital spend, right? Means your purchase of fixed asset, your capex. So if you use the cash flow statement, straight away you can get the answer. However, if you want to use the balance sheet, that's fine too. Can you see the gross fixed asset? You just take 2850 minus 2501. and this should give you your net capital stack. Okay, working capital investment. So working capital, again, I would like to use the cash flow statement. So let's see where's the working capital. Remember, working capital is current asset minus current liability, right? Okay, let's see what the current asset are. I found it here. Can you see change in working capital? These are the four items. We just add them up together. You can get the answer. However, if we like to use the balance sheet, no problem as well. Let's pick the items that we want to include. So we need accounts receivable and inventory. So we need this, right? And remember, we need to minus because we need to take 513 minus 474. And then we do the rest as well. We need to do the payables here, and accrued tax. Do you notice that note payables is not included, right? Because note payables are debt instruments. So anything that is a note is a debt straight away. All right. So next formulation we want to calculate is the FCFE. Okay, so all these are fine. We already done this. Now I would like to focus on net borrowings. So how do we get this net borrowings figure? Again, we can refer directly to the cash flow statement. Let's look at the borrowings amount. There I found it. Financing activities, 10 plus 40. Here's my net borrowings. However, I can use my balance sheet as well. Okay, I saw that my note payable increased by 10. So it's 10. What else? My long-term debt here increased by 40. So though for those that have a strong foundation for accounting, I hope you know why when your note payable increase, see, from 27 to 2008, increased by 10, right? But I hope you know why in the cash flow statement itself is a negative. Why is not positive? You don't have to know it for finance, but in accounting, the thing is your cash flow statement is actually derived from your balance sheet, and there are some adjustments in terms of minus and negative and positive. So for this, your financing activity, it's a negative. That's why there's brackets there, right? But it's not important. So because for finance, we just want the absolute number, and then we put it in the formula. At this point, I just want to highlight to you that there can be a reduction in the note payable. What does this mean? It means that the note payable, let's say note payable, okay, let me just use a different color. Note payable, it can be 2007, year 2007, year 2008. It can be such that maybe here is 200 and then it goes to 100, right? Yeah, lesser debt. So because of this, it becomes a negative, negative 100. So you need to put a negative into your free cash flow to equity formula. Okay, so we have a question here regarding to trade. So yes, for payables relating to working capital, they must be relating to trade. Yeah. Tapu, any questions for this? If it's negative, so this is negative here. All right, then that's all. I'll not go through part C because at the end of the day we are just focusing on picking. Any questions regarding picking of the items required from the financial statements? No, no, we're good. Okay. Okay. We have one more question. Again, this is about picking the items. But now what formulas you want to use? So they say that they want you to use the free cash flow, not free cash, sorry, cash flow to operations using the cash flow statement, right? Okay, so using a cash flow statement, let's go back to the cash flow statement. How do we pick the cash flow to, for operations? So this is quite easy. We just go to the cash flow statement. Where's the cash flow for to operations? Here, right? Cash provided by operating activities. Okay, the rest are the same for the interest and cash flow uh, of fixed asset. So next, we want to pick for EBIT and EBITDA, right? And the good thing is that it is provided to you in the statement. So EBITDA and EBIT. So you just plug the figures from the statement of income. So I want to highlight that sometimes the financial statement might not have EBIT or EBITDA. So I encourage you to use the formulation for net income, because net income is always provided, right? But not it might not be uh, uh might not have net income. It might not have EBIT or EBITDA. Also, when you look at financial statements, they can be quite complex in a sense that they might have minority interest, they might have like uh income from equity holders. I hope anyone knows the income from equity holders. Share of income from equity holders. So share of income from equity holders, if you do have a accounting major in your team of good. So basically it is for associated companies, right? Associated companies meaning that okay, so subsidiaries are 50% owned, associates are less than 50% owned. So they basically are not consolidated into your financial statement, but they are they are they provide a share of their income. Like for example, if they are 25% owned, they provide 25% of their income into the mother company. So that's the share. So it's not it's kind of like you can think of it like dividends, but it's like the share. Yeah. Yeah. A bit like profit share. Yeah, you basically they need upstream the profits. No, so you focus on group. Focus on group. Yeah. Okay, so what's the difference between group and company financial statement? Okay, so group means that all the subsidiaries in the group is consolidated and you formulate the financial statement, right? Now, if you look at company only, it means that you're looking at the parent company. So let's say the company is Sintel, right? You're just looking at Sintel itself, but you're not considering all the downstream companies because Sintel has various subsidiaries in, like say, Australia. They have companies in India. So you want to look at the group because it gives you a full picture of the company, not the company only financial statement. Okay. Um. All right. I think that's all I want to cover for the self-practice question we are picking. Uh, Yes, we use the group for Syntel. Or any companies, usually we just look at group. We don't look at we never look at company. Yeah. Okay. So I think at this point in time, maybe let's take a break before we go through the TMA. Because we are done for today's lecture. For those that came slightly later, I just announced that the TMA results were released early this week, actually late last week. So you can go to your Canvas to have a look at the results. At the same time, there are some comments, if you do have any questions, now will be a good time. After the break, we'll go through the TMA as a good also learning process, right, for valuation. So we'll take a 10 minutes break. Maybe we'll come back at 8:55, right? We come at 8:55, and then we can answer any questions regarding TMA. So for this portion of the discussion, it'll be more of a discussion, right? So I hope you have questions. If you don't, I won't be like going through every single question, but we'll just like discuss like some key points. Okay, so we take a break. We come back at 8:55. Take a 10 minutes break. And do you have any questions? Feel free to put in the group chat. Right, welcome back. Okay, so we do have a question here. Whether we go through the GPA answers? Yes, we will. We'll do that on the last lecture. We'll go through the GPA answers. So you will do the TMA now and then the GPA on the next lecture. Okay, so let's look at the TMA. I hope you do have questions as we go through the question, as we go through some of the problems here. Okay, let's look at the problem here. So question one, what are we looking at? Um, So they give you not really a scenario, but they give you a real life kind of situation. Uh, they say due to aggressive easing of monetary conditions during COVID, result in global inflation. Reaction to this, central bank around the world have raised interest rate. While this has caused inflation to come down from this peak, the fear now has shifted towards more of a recession. Okay, so before we just discuss about some of the pointers to consider in this question, just want to highlight that I think overall the class did very well. I think average mark is uh, more than 70, slightly more than 70. At the same time, a lot of the marks are being skewed in the sense that most of the marks are skewed towards the right, meaning that a lot of people score very high. So those that did not score too well, do not be worried. Feel free to approach me, drop me an email if you are uncertain about certain topics. And if you have any questions, do reach out because now I think there's still time to see what we can do. Uh, and for your GPA and more importantly, also your finals, right? Uh, okay, so some general comments first. For the TMA and also for subsequent other assessment that you have, you should be very careful when you read the question to answer the question directly. All right. So avoid giving any definition. So you do not have to define anything, right? You do not need to define what is a recession. You do not have to define any any details, right? Just go straight to the question, answer the question directly to save, because a lot of time you see that word limit, right? So as I mentioned in the last lecture, I'm not so sure about word limit, but at the same time, of course, if you write twice as much as word limit, that's fair for your classmates, right? So of course I cannot accept that. But generally, I'm not too strict about it. But you want to be very careful about writing definitions and not answering the question. So you need to be very direct to the question. Okay, so what does this mean? Let's look at this question here. Okay, while there's a general consensus that the words entering a recession determine whether this recession can be expected to be severe. All right, so I think quite a few of your uh okay, maybe not for this question, that's question C. Okay, but for question A, a lot of people try suggest indicators of possible recession, right? But you need to read this question very carefully. So indicators and determine whether the recession. So when you say determine whether, it's about factors affecting the recession, right? Not about indicators. So remember, indicators could be lagging, could be leading, right? Remember in lecture one we talked about it, but they might not. They only indicate a recession or not a recession will happen, but not really what's influencing causing the recession. So this is the different part. So I think some of you might have a small comment about, oh, I think what I'm talking about is more indicators, right? So you need to be very careful. And this is a point where I want to highlight that you need to really answer to the question. Okay. Question one, any doubts or any clarification? So this is the main part. Most people, or not most, but like the handful of your kind of answer the question using indicators, but we don't want that. Okay, so I do have a private message, but I'll not mention the name or anything. So in case you do not score well, in the sense that you did not pass the TMA, do not worry because it does not mean that you are immediately kicked out of the course, right? So you are still in the course. That's why I say for the GBA or even your finals, put in more effort. And if you do have any question, no, do not hesitate to reach out to me, right? And ask the questions. Okay, so yeah, what would be better than just indicating indicators for determining severity? Okay, so I think some of the indicators that I saw things are like the GDP, right? Or the GDP is going up, or employment, right? I think those two are quite common. The GDP and employment. Remember, GDP and employment, right? They are indicators of recession, but they are kind. Okay, employment is definitely a lagging indicator. GDP has a lot of issues, and more importantly, they did not determine whether a recession is expected to be severe, right? So it can you can use those indicators as factors, but you really need to phrase it carefully here. For example, okay, if you want to talk about employment, right? So if you say something like, oh, the em- the labor market is still very strong. There's a high demand for labor force, and there's insufficient laborers to meet the demand. Okay, so this is a very unique situation. Remember, in most recession cases, the labor market is very weak, meaning that people are being laid off. But this is a very unique situation where the labor market is still very strong. So this might actually say that, hey, you know what? Actually, there's insufficient laborers, and companies are still demanding more stuff, which means that if a if more and more people are being employed, chances are the recession will not be severe. Okay, so if you phrase it in that sense, yes, you are talking about employment, but you're talking about it not from employment rates. You're talking about for the demand for labor. That's okay, that's a factor. But if you just say employment rate is increasing or decreasing, then this let's say employment is increasing or decreasing, and this shows that recession might happen or not happen. This would be now more of an indicator. Yeah, everyone kind of understand? Yes, like really uh that's like really answering the question, right? Determine whether the recession can be expected. So it's about phrasing, right? So yes, it can be about labor, but not about employment rate. Employment rate is an indicator, but you say labor demand, then there's a different thing. Yeah. Okay. So yeah. So again, for those that are concerned about um that do not pass the TMA, do not worry, you'll not be kicked out of the course. It will, of course, impact your overall score. So I really encourage you to work hard for your GBA, but more importantly for your finals, right? Because your finals is 50%. So that's quite substantial. And of course, your final is it's your own take-home kind of assignment. So I really encourage you to uh, uh, put in effort for that because that 50% really makes a difference, right? Um, and more importantly, also, if you do have questions, really reach out and ask them and clarify them, whether is it to class or is it just drop me the email. Okay, so part B, appraise the impact of recession on three sectors. This one I'll not really go through. This one I think almost everyone got the full mark, right? If you just give three sectors that make sense and not repetitive, you get full marks. So no problem with this. Part C, okay, this one's a little problematic in the sense of whether you're answering the question again. So let's read the question carefully. Discuss whether you think the banking crisis in Silicon Valley, Signature Bank, and Credit Suisse will lead to a contagion in the global banking sector. Okay, so number one, again, we want to avoid any definition, anything that is describing, right? So we should avoid describing what happened to Silicon Valley, what happened to Signature, what happened to Credit Suisse, because you must assume that the examiner already know this, right? Because they're asking you more importantly whether the banking crisis will lead to contagion. So it's about the banking crisis and contagion. right? So that's what we are focused on. Not about, okay, what happened to Credit Suisse, what happened to Silicon. Yes, you need to know what happened so that you can explain whether you will result in a contagion, but not necessarily describe what happened. Everyone understand about this? The difference? Yeah. Okay. Okay. So now, then some of you did a very good description about what regulatory um, implementation has been done, which is very good. However, as it is a 10 mark, usually they require 2 to 3 points, right? And when we talk about 2 to 3 points, we are talking about points that are separate. Meaning what? Let's say if we talk about a regulatory, let's say the Fed or some of you use the Basel III regulations, requirement for capital, minimum capital. So those are regulatory, right? Okay, so that's one point. But if you just talk about regulatory purely, let's say you just talk about Fed, you talk about Basel, you talk about capital requirement, you talk about maybe security mix, right? The mix, how much debt, how much equity that the bank must hold. Like, so those are purely regulatory. So if you only talk about regulatory, unfortunately, you cannot get a full mark because the marking scheme is quite strict. They want differing kind of pointers, factors, right? And this is, I guess, quite applicable to most of the other modules as well, in the sense that when you put in a few points, you want to try to have a more diversity. So let's talk about regulatory. Maybe you want to talk about uh, perception. Perception is nothing. So hopefully I'm not sure where you learn about things like herding, herding biasness, when people herd together. If like one bank collapse, the rest of all people will be afraid and they all herd together by pulling money out. So like that's another kind of um, factor that will affect, right? So it's like totally different. One is about perception, one is about regulatory. Okay. Any other questions here? Okay. Next thing, calculate the cost of equity. This one, everyone got it. I think 90% got it. One point to highlight to you is that you see this beta. So I want to highlight, probably you have learned this in, and not probably, but you definitely have learned this in your FIN 203, because I previously taught that module. But it's beta, you need to know that beta is additive. Okay, I repeat, beta is additive, meaning what? You can add the beta. So you can do 1.4 plus 1.5 plus 1.3 divided by 3 to get average beta. Remember, only beta, in this case, only beta is additive. If it's a standard deviation, if it's uh, so standard deviation is not additive, right? You cannot add standard deviations because standard deviation is kind of like measure of risk as well, right? Total risk. So beta is additive, standard deviation is not. So some of you, I think, went extra mile to calculate the cost of equity for each of the beta, then you take an average of it. You'll get the same answer as just taking the beta and average it because of the nature of beta that is additive. Now, part B, I think only one student got this full marks. Why? Okay, so they say that, okay, let's read the question. The CEO informed you that you should consider using dividend to value a company. He said that he's paying a constant basis of 20%. Okay, fine. While retaining the need for business. Okay, but what is this question about? So, so you have this company HK Creation, specialized in providing customized software solutions. Recently have been caught attention of listed company and wants to discuss possible acquisition. Okay, this is very important. Remember, you take the position of an investor, right? You are trying to value a company now. And what is the purpose of your valuation? Because that is the basis of why you even do valuation, right? And why we choose the model. So I think a lot of your get the marks in the form of, okay, okay, you do this because it's 20%, it's stable. Yeah, yeah, those are all correct. Like it's stable, so you should use DDM. But the thing is, you need to bring in the purpose. So at the end of the day, you're doing a value acquisition, right? When you do an acquisition, what does this mean? You are acquiring the firm. So remember when we talk about DDM, I mentioned that, oh, for DDM, you are generally a non-controlling minority shareholder because your purpose is just getting dividend, right? You're not talking about capital appreciation, right? But in this case, the purpose is acquisition. So it should be not appropriate or inappropriate to use dividend to value the firm. Because if you're acquiring the firm, you're not going to get dividend, right? You're acquiring, you are like you have the 100% acquisition, but you're getting the whole firm ready, right? So you must go back to the purpose of acquisition. So basically, for this answer, you need to say, okay, what's the purpose of your valuation? All right, and then you mention, oh, because it's stable, it's 20%, etc., and therefore it's not appropriate. So at the end, it's not very ups. Yeah, yeah. Okay. Everyone clear about this? Yeah, acquisition. Okay, so I think there's a question regarding the purpose of valuation. So whenever you choose a valuation method, always think about the purpose of your valuation. So in this case, the purpose of valuation is to acquire the firm, right? You want to value, then you acquire. And when you acquire a firm, immediately you should think that, hey, DDM is not appropriate because DDM is only if you are a minority shareholder, then you care about the dividends, right? You use the dividend to value the firm. But if acquiring the whole firm, you know what? Actually, you might even want to do FCFF, right? Because you want to see what's the free cash flow to the whole firm. Because if you're acquiring the firm, you are not just a share equity holder. You want to consider the debt component as well, right? So you want to do FCFF, right? So always consider purpose of valuing. However, if your purpose is to buy 10% of Sintel, let's say, okay, then you know what? Use DDM. That's fine because 10%, right? You just want the dividends. Yeah. Okay, discuss three problems. This one I'll not go through. I think majority of you, 90% all got it correct. You just find some problems, you just comment on them. Okay. This one, first of all, this one, you need to use the debt ratio formula. So assess the cash flow for part A, you need to use the debt ratio formula, right? So I hope you still remember the debt ratio formula that we talk about. You need to use that. So you cannot use net debt, net borrowings, and all those because it's very you cannot derive net borrowings. So you need to use the debt ratio formula. So if you use the wrong formula, unfortunately, you are not able to get error carry forward because there's not really like a calculation mistake, right? However, if you calculated the FCFE wrongly in part A, you still can get some error carried forward marks for part B, right? So that's fine. But you can't get the full marks, of course, for part B. What else is important to note here? So one thing to take note is that for this, for 2026, the cash flow goes at 3%. So you need to do a perpetual, right? Rate of 3%. And because they only give you information up to 2005, 2025, sorry. Part C, last but not least, appraise. So I think everyone got the marks. We might lose a bit of marks if you know, pick up the valuation. So the problem with this valuation, I think I recall I mentioned this in the last lecture as well. The problem with using FCFE or this kind of valuation, I think in lecture 2 I also mentioned that a lot of weight is given on the growth factor. So actually that's the main problem, right? If you estimate the growth wrongly, the whole thing is wrong because there's a lot of value given on the growth factor which impact the terminal value, right? So that's the important part you need to take note of. You can give other explanation and all, like if it's too remote, the explanation is too remote, unfortunately you lose some marks, but you must really pick the main thing, like the growth. I think some of y'all mentioned about the cost of equity. Cost of equity, the estimation might be that. Yeah, that's fine too. One more thing to highlight here. I think in this lecture I keep on mentioning, this is working capital requirement. So you want to always use the change in working capital. So you want to use the 8%, 8% increase. I think also for this question, I think one student, the one that read in advance, use different betas, like the cost of equity at high growth, cost of equity at low growth. You got the full mark as well. That's fine. It's an alternative answer. You can do that too if you write the assumptions. Yeah. But since this question is not so obvious that you have a high growth, low growth, that's why if you just use average beta, it's also fine. Okay. Any more questions regarding the TMA? I know there was one I think marking error for one student. The student emailed me, so that is being already changed. But it takes a while to be reflected in your grades. But if you do have any calculation mistakes in terms of the marks, do reach out to me. Let's see what we can adjust. So last call for questions. Yes, no questions. Okay, so now let's pause the recording